Good morning. Good morning, everybody. We're just going to wait as we get all the attendees in. We've had amazing. We've had circa 150 people register for this event, so that's great news. We'll just give it a minute. Morning, Lee. Thank you, Richard.
Presumably Richard doesn't know we're doing tax.
Well, we made it fun at the conference, Harvey, so that's no pressure there then. Good. I'm going to take prerogative and start. So welcome to our AFP webinar. Thank you very much for attending. My name's Rick Baird and I'll be hosting this webinar. I'm a director of the AFP and also our company secretary. So this webinar will be focused on company car tax and salary sacrifice schemes and the evolving landscape surrounding them. As recent budget changes begin to impact the tax treatment of electric vehicles, clearly a key driver for salary sacrifice uptake, this session will explore what these developments mean for organisations running or crucially considering running a salary sacrifice scheme. So before I get started, I just wanted to give an AFP update, if I may, 3 slides, and then we'll get to the meat of things. So events, up and coming events, lots going on. AFP conference, 13th of May, as usual, at the British Motor Museum. We've got over 300 attendees registered. So I don't know how many we can take in that place, but that's really excellent news. It was oversubscribed last year. Fleet Operators Lunch in the Midlands, that's going to be hosted by Julie Summerell and Martin Evans on the 5th of June. To any fleet operator members who were at the CV show, it was at the barn at Merryfields, we're in the same place. Fleet Operator Dinner in Bedford, after day 1 of Company Car in Action on the 10th of June, Fleet Operator Dinner at Warwickshire, and that's before the Expo on the 8th of September. Then we've got the AFP Expo itself at the British Motor Museum on the 9th of September. You know, a shameless plug, please do come along. You've got lots of fleet support members there, really showing their wares, and our Matt on the call is very much a champion for that AFP Expo, so thank you. And then finally, Fleet Operator Dinner at Hampton Manor, and that's day 1, after day 1 of Fleet Mobility Live on the 6th of October. So fleet operators, you can book to join any of these events in the event area of the AFP website. Next, up and coming training. I'm not going to go through all of these. I just wanted to pick out three pieces, if I may. The Fleet Vehicle Management Strategic course. We've got a new cohort starting on the 6th of May. And then something a bit different. We've got the Fleet Mindset Masterclass on the 4th of June. And this is specifically for suppliers, so for our FSP membership. I'd urge you to take a look at that. And then we've got our foundation course, 24th and 25th of June. And we are restructuring the advanced course, and that's going to be being relaunched in October. Ronnie has told me. It will be a 1-week course centered around preparing a business case proposal. And you can find out more about these events, or sorry, these trainings on the AFP website under Education and Training. And finally, lobbying. Look, we're delighted to have Dale on board, ex-Environment Agency. He is responsible and heading up our AFP lobbying. We have submitted our responses to the EVED and also the HGV consultations. You can actually see those responses on the link there. And we are publishing our manifesto shortly. So now on to the webinar itself. I'm joined on this call by Harvey Perkins and Matt Hammond. Guys, thank you very much for doing this. And we're going to split the seminar into 2 sessions. Harvey is a director at HRUX, and if you don't mind saying so, Harvey is our resident AFP tax guru. You've been upgraded from expert. And Harvey will give us an insight basically into the market context around, well, basically around taxation and also sales tax. He's going to look at company car tax. How many more acronyms could we get in? He's going to look at company car tax around BEVs, so our battery electrics. He's also going to give a piece around company car tax and our plugins, our PHEVs, and then salary sacrifice. You know, what's the tax position currently, and then a budget update and the implications, importantly, of EV related budget changes on schemes' viabilities and their attractiveness. And then we're going to have a session with Matt. Thank you, Matt. Matt is a fellow AFP director, is also a fellow, and his day job is as head of fleet and plant at Altrad UK and Ireland. For those of you into your rugby, Altrad are the sponsors of the French team. Matt's going to provide a practical overview and his views on pros and cons of running a salary sacrifice scheme from basically a real world perspective. So, you know, how the Altrad scheme has worked, its implementations, actually why they did it in the first place, the pros and the cons, both I suppose from a company and a driver perspective. And, you know, as a disclaimer here, basically the position there, it's important to note that these are Matt's views and not the AFP's or Harvey's or HRUX's views. And we are supported on this seminar by Carolina and Carly. And if you have any questions, can you put them into the chat, and Carolina is going to go through those. So Harvey, over to you, sir. When you want me to change your slides, just let me know. But Harvey, the floor is yours.
That's wonderful, Rick. Thank you very much. Good morning, everybody. So as Rick says, just going to talk a little bit about salary sacrifice primarily and the tax issues associated with salary sacrifice. I've got about 30 minutes, maybe a little bit more, maybe a little bit less, so stay hydrated. What I'm going to do is I'm going to talk initially about context, then I'm going to talk about the tax rules themselves, and then I'm going to do a little bit of a budget update. I think the context is interesting because there's an argument that salary sacrifice for EV company cars is probably the most exciting business sector in automotive in the UK. Now, that's a relatively low bar, given where we're at as a nation, but still, I think, quite interesting. So I've got a couple of graphs and then the summary. This is showing you UK new car registrations by fuel type, reading that because it says it at the top, from 2014 to the current day. You can clearly see the impact there of COVID with the reduction between 2019 to 2020 in terms of the total number of cars being registered. So we used to do just over 2.5 million a year, and we've been doing that for like 10, 11 years prior to 2019, 2018. And then it falls down to 1.6 million for the next 2 or 3 years, and it's steadily recovering now. We're back up to about 2 million, but we're still doing 500,000 fewer cars as a nation than once we were. And that's despite the fact that there are more cars on the road than there have ever been. So arguably, we're registering fewer new cars, but we're keeping the older cars for longer. So we're scrapping fewer cars at the end of their lives. The other thing that's interesting is the orange section, which is diesel, which has just basically collapsed. It's gone from being half the market to almost nowhere over the course of those 11 years. And then the growth of BEV in green there, PHEV and hybrid, which you can see by 2025 is about half the market. In fact, it is now half the market. So last month was the first month where petrol and diesel was less than 50% of the total market. So I would argue that those three sections have broadly replaced the diesels. The petrol is reducing, has reduced, but by nowhere as much as diesel, which has basically just gone away. So whereas a typical company car was a diesel in 2014, it's now an EV. And I think these figures show that quite clearly. Go on to the next slide, please, Rick. This one just looks at two things here. The one on the left looks at the rolling 3-month average. So I've done it as a rolling average because every single month it goes up and down like a yo-yo. So in any given month, EV might do really, really well or really, really poorly. And all the newspaper headlines are like, well, that's it for petrol, it's finished, or EV's just had a terrible month. But the reality is that the trend is petrol is declining. So the top line there, the blue line, is petrol just declining month after month after month. The green line is EV. The reason why we've not seen quite a good result from January 26, Feb 26, March 26, just the last 3 months there on the left, is the impact, in my view, of the ZEV mandate. So every single year we get a bubble at the end of the year as manufacturers are desperate to register EVs and register fewer ICE vehicles in order to make sure they hit their 28% last year. It's going to be 33% for cars this year, ZEV mandate. So, all right, there are mitigating factors, but at the end of the day, if you're an OEM, you want to register those EVs as you approach the year end. So we see that wobble, but it's pretty clear, I think, from the trend there that we're seeing petrol in a constant decline and EV in a fairly steady increase. On the right-hand side, I've just shown you the total number of EVs registered each year. It goes up by about 80,000 a year. It's pretty linearly, actually, I can't say linear, each year. So it's not as a proportion, it doesn't seem to be curving up. It seems to be a straight line for the number of EVs we add year after year, but somewhere around 80,000. And there were 473,000 EVs registered last year, which was just under a quarter of the total for the UK in terms of all of the cars registered. At year end, it was 1.8 million EVs on the road. So if you just add up those rows there on the right-hand side, you get to 1.8. Given what's happened in the first couple of months of this year, we're now well over 2 million EVs are registered on the roads in the UK. Could you go to the next slide, please? So on the right-hand side there, I've just got some stats, just overall comparing 2015 to 2025. So diesel 1.2 million down to 100,000. That's the big mover. Petrol 1.2 million down to 938,000. So down, but nowhere near as much. BEV from 7,000 units registered in the whole of 2015 to 473,000 last year. The other thing which I think is quite interesting, if you look at the purple box bottom right, is that it used to be 50-50 private and fleet, and now it's 40% private for the all registration, 60% fleet. Some debate about how you measure those values, but it's pretty clear that fleet is now taking the bulk of cars in the UK, or registering the bulk of cars. Summary on the left-hand side, market down by 500 to 600 units per annum. Circa 2 million EVs now on our roads. Petrol and diesel, now less than 50% of cars being registered month on month. Diesel has basically just crashed from 1.3 to 100,000 units, 1.3 million to 100,000 units. Retail is down, but actually so far in 2026 is doing a little bit better. EV sales are mostly to fleet. This next one I get from various different sources, and I think we should take it with a pinch of salt. But we think that salary sacrifice is around 270,000 of those 2 million EVs on British roads. So salary sacrifice represents 270,000 units. We think it was about 25% of all EVs registered last year was salary sacrifice units. So EVs in fleet booming, salary sacrifice as a sector within fleet booming. We're seeing lots of evidence of used car EV sacrifice also booming. So several of my clients offer used cars on their salary sacrifice schemes and are reporting strong leases of those units. And that's a function, I think, of the funders managing their RV risk on electric cars by pushing them back into release rather than letting them go into the market. So lots of interest in used car EV salary sacrifice. And PHEVs finally is actually technically the biggest growing sector. But as a company car will cease to be attractive from April 2028, or as attractive, and I'll explain why in just a second. So the context is interesting because hopefully it proves that EV uptake in fleet is critically important to the UK automotive market, and that salary sacrifice is an increasingly large component of that. 25% of all EVs registered being salary sacrifice cars last year, which I think is an interesting stat. Rick, if we could go to the next slide, please. So some of you will see this before. This is my periodic table, if you like, of company car rates. I know it looks a bit complicated, but if I can explain. So if you look at the box in the middle there, 2026, 2027, and then down the left-hand side, CO2 emissions. So what we're basically saying is if a car emits 0 grams of CO2 at the tailpipe, then the percentage scale charge is 4% for that vehicle. So just to put that in context, what we're saying is if a car had a list price of £100,000 and you were lucky enough to be given that as a company car, then you would be deemed to have received, for tax purposes, 4% of 100,000 as income. So you've got a deemed income of 4% of £100,000, £4,000. You will pay tax on £4,000 at whatever your marginal rate of tax was, for 20, 40, 45, etc. Historically, 16%, 15% is where these bands started. So 4% is incredibly low. And I know you only have to go back 4 or 5 years and it was 0, but still 4% of the list price of the vehicle is a very low charge for a car historically. As you get into the plug-in electric hybrids, you see the rates go up. So again, if we look at the left-hand side, if your emissions are between 1 and 50 grams of CO2, you then have to consider the zero emission mileage, at least you do until April 28. So if your zero emission hybrid mileage is between 40 and 69 there, so that's the 4th row down. You've got CO2 emissions of between 1 and 50, and your zero emission range, according to your V5, is between 40 and 69, then your tax charge for the current year is 10%. So a £100,000 car, you pay tax on £10,000. 28-29 is interesting because the rules are changing. In 28-29, the 1% per annum increase that we've been seeing becomes 2. So company cars that are fully electric will go from 5% to 7 and then 9. But if you're a plug-in electric hybrid, the whole concept of zero emission mileage will cease to exist. And if your CO2 emissions are between 1 and 50, you'll just go to a flat rate of 18% and then 19%. So there's a massive hike in the tax and national insurance liability on a plug-in electric hybrid if you're still using it as a company car in April 2028, an overnight increase of more than double, depending on what car you've got. I've color-coded these bands just to show you what's good and what's bad. You can see that if your CO2 emissions are 150, then your liability is 36%. So a £100,000 car, you'd be treated as if you'd received £36,000, and you would pay tax and national insurance based upon, or you would pay tax and the employer would pay national insurance based upon that value. You can see those rates are also going up. So from April 29, it will be 38%. The other thing to say is we don't know what's going to happen in April 2030. Given everything that's going on in politics, you might argue we don't know what's going to happen next week. But certainly when we get to April 2030, there's no guidance from HMRC and from the government as to what's going to happen next. So whether or not we'll see that 9% for an electric company car become 11, or whether it will go up closer to the 15% that historically has been the entry point for these charges, we shall see. I can tell you that as long as the charge is less than 15%, mathematically salary sacrifice will still be attractive. Obviously, there's a number of factors there. It depends upon a number of different issues. But when you do cash for car calculations, once the scale charge of a car gets above 15%, you start to look at cash as being a more attractive offer for the employee to take the car and run it privately than as a company car where you have to pay tax based upon the scale charge. So hopefully that will make sense. As I say, the big news is that from April 2030, we simply don't know. But the flip side is from now until April 2030, assuming we don't get a change in government, then these are the rates, and we understand what the rules are going to be for the retention cycle of the next car that you take, which has always been government's goal, is to give us clarity for at least a retention cycle. we could go to the next one, please. So what does that mean? This is a screenshot from Car Award. So I'm not trying to sell Car Award, but just thought it was a nice way of illustrating the points. You've got 3 cars here. They're not all the same price, but they're all sort of the same car, as in a mid-size SUV. The car in the middle, the Kia Sportage, is a hybrid. So CO2 emissions on that will be above 75. The car on the left, the Tiguan, is a PHEV. So CO2 emissions on that will be under 50. We'll go on and talk about CO2 emissions for PHEVs in a minute. But let's just accept for now that it's under 50. And you can see that the electric-only range on that car is 74 miles on the left-hand side there. And the car on the right, the most expensive, is an Enyaq, which is all electric. These are actually company cars. This is not salary sacrifice. So if you come down to the calculations at the bottom, you've got 3 numbers for each car under business contract hire. The first number is the trade up, trade down on whole life cost. So these are whole life cost allocated vehicles against an employee's budget. And what we're basically saying is that the Tiguan is a trade up of 54 net. The Kia Sportage is a trade down of £1.34 net. And the Enyaq is a trade down of £39.60 net. But look at the company car tax. So the company car tax on the hybrid in the middle, £386 a month. That's the tax charge for the privilege of driving that car for private use. The Tiguan on the left, which is a full PHEV, is £185, and the Enyaq on the right is £105. So overall, the most expensive car here, the £51,000 Enyaq, is by far and away the cheapest company car for the employee. And that's how these sums are working out. So tax is such a major factor in the cost comparison for a car that it basically overweighs everything else. So you have a scenario here where for a 40% taxpayer, which I believe this one is, you would be so much better off having the Skoda Enyaq over the Sportage, despite the fact that on paper at least they do the same job, that you could afford to spend 15 grand more on the Skoda in terms of list price. The other thing to say is when we work out the company car tax, we do it at an average over the life of the contract. So Rick, if we could go to the next slide. Just to show you for that Tiguan, bottom right-hand side. So the actual per annum tax charge for this car is 105 for the current year, 120 next year, and then in 2028, the tax charge for the employee, this is what the employee would have to pay, 272. So you can see how this is an attractive or relatively attractive company car until April 2028. And then you just step off the edge of the cliff and the tax charge becomes 272. So these are becoming less attractive as we approach April 2028. There are some wonderful PHEVs out there. We've got some new Chinese PHEVs with incredibly high EV-only range. But the problem is that from April 2028, if it's got an ICE engine in it, then you're going to pay tax on the basis of 18% minimum as a scale charge. And that's going to massively increase your liability as employee and your NIC liability as employer. Hopefully that makes sense. Hopefully you're hydrating, paying attention. If we move on to the next slide. Could you, this one builds, so could you just build, I think it's 2 more clicks. Thank you. I don't know why I gave it to you as a build. It's because I don't understand PowerPoint. I just wanted to talk about what salary sacrifice was. So I've said this before to this audience. I keep going on about it. Basically, as I know you all know, if you give an employee a company car under a salary sacrifice arrangement, it's a company car. The salary sacrifice is basically the method that you've allocated the car to the employee. So it's a financial calculation that underpins the provision of the vehicle to the employee. But the car itself is a company car. It will go on Form P11D if you're still using those because they're being phased out. And you can only pay the AER rate, which is 7p a mile, or the new third-party charging rate, which I believe is 14. So it will be a company car. And the question for the employer, therefore, is what does the salary that the employee needs to sacrifice in order to pay for this vehicle? Because the contractual liability will be between the employer and the provider of that vehicle. So whoever's providing your salary sacrifice cars needs to provide the employee with a cost for that vehicle, but the cost to the employee is the net equivalent of the salary that they will sacrifice. So how do you work that out? I thought I'd just run for a quick example. So this is, I've made this car up, you can see, because all the numbers are very round. But basically, I'm saying that if the employee wants a particular vehicle, let's say the employee's decided what that car is, then we would look at what the cost to the employer of providing that car would be. And we would look at everything we know about, and we would also consider things we don't know about, but things that might happen, like an early termination charge or maybe excess mileage. So if we start with what we do know, we can get a BCH rental calculation for that vehicle based upon the term and the mileage that the employee thinks they're going to do. In this case, it's £400. We can get maintenance. Again, we want, if we're the employer, to make sure that our costs of providing the vehicle are covered by the sacrifice that the employee makes. So maintenance is an attractive product because you can buy and then know that the cost of maintaining that vehicle is effectively covered by the amount that you're paying monthly. It's a company car, so the employer is going to insure it. So I've put insurance in there at £110. It's a company car, so you can recover VAT if you're able to recover VAT on general overheads as a business. So I've added back the fact that not all the VAT on rental can be recovered. So in the UK, if there's private use of the car, which of course there will be, you can only recover half the VAT on the rental. So in this case, the rental's 400, the VAT would be 20%, so half of that is £40. So I've added that back in. The employer is going to pay Class 1A employer national insurance on the Form P11D. As I say, if you still do them, if not via payroll. So we'll add that back in, and that gives you a total of 600 quid. So what I'm saying effectively is that the employer's P&L hit for providing this car to this employee, if everything goes to plan, is £600. On top of that, the employer might want to buy insurance to cover early termination. On top of that, the employer might want to put a provision in place to give themselves a little bit of money to one side to cover unexpected costs, like maybe accident damage or a contract damage. These are the debates that we have with customers, but let's keep this simple and say in this instance, it's £600. So the sacrifice to the employee would be £600. You say, yes, you can have that car, but you have to give up £600 gross from your pay. And if the employee does that, they don't pay tax, in this case, £240, and they don't pay NIC, in this case, £12. So they can fund a £600 vehicle at a cost to them of £348. And it's fully insured and it's fully maintained. So all they would have to pay in addition to their £348 net is they would have to pay for the electrons that they put in the tank of the vehicle. So that's the attractiveness of salary sacrifice. It's a £600 car, but you're only asking the employee for £348. But you're doing that by adjusting their pay. You're reducing their pay. They are signing a contract to agree to a reduction in their pay of £600 a month, £7,200 a year. But that only actually costs them £348 because of the way the tax system works. Also, because you're not paying the employee £600, you also, as employer, will not pay national insurance, in this case of £90, 600 at 15%. So that's the employer national insurance charge. And what some employers will do is they'll take that £90 and they'll put that back into the calculation. It's not quite a pound for a pound because it's circular. But what the employer might do is say, well, I'll give the employee £80 credit towards the cost of this contract because I know that I'm going to save NIC on the salary that they're not going to be paid. So that's when we talk about whether or not the employer wants to reinvest part or all of their national insurance saving for the employee, or whether they want to keep it. I'd say most employers pass some or all of that on now, although some still do keep the national insurance saving. And of course, there are providers out there who are very focused on talking about the national insurance saving for the employer. But I would suggest that where the employer keeps a national insurance saving in full, there's a marked effect on take-up in the scheme. So when you look at take-up percentages, you know, the total eligible population of employees versus those that actually sign up for a contract, if the employer plows the NIC savings, some or all of it back in, you often see an improvement in take-up. So the scheme, if you like, is a little bit more successful at the cost of saving the employer less. That's the fundamental maths that sits behind the salary sacrifice arrangement. Just to summarize on the right-hand side, it's a company car, normally funded under business contract hire. It doesn't have to be. You can buy it if you want as the employer. But the advantage of business contract hire, again, is you have a fixed cost of that vehicle per month for 36 months. And if you return the car under mileage and in a good state of wear and tear, then that's all it costs you. Whereas if you buy the vehicle, you're taking a risk on the residual value, which you can't necessarily pass on to the employee. It currently only works if the car emits 75 grams or less of CO2 at the tailpipe. So it will work for electric cars, but it also works for PHEVs, but it won't work for any petrol or diesel. There's no petrol on sale that emits less than 75 grams, although I believe there's some now that are in the 70s. So there are some very, very efficient hybrids, but they don't quite get there unless something has changed that I've not seen in the last couple of weeks. And the amount that the employee sacrifices saves them income tax and NI, and it saves the employer NI. And it's those savings that make this work. Hopefully that makes sense. If you're happy with that, I'm going to go on to what I think is my last slide. I said I would talk a little bit about the budget. The budget is about, well, I'd say it was a fairly weird budget in that there's a whole bunch of things in it which are either not going to happen or didn't happen. And I'll explain why I think that. So we start with the PHEV CO2 easement. So this is the new rules on emissions testing for PHEVs. That means that from January last year, as this rolled out, you started to see PHEVs with much higher reported CO2 than they had before. So you get a car which was maybe 30 grams of CO2, and the car would come and they would report the CO2 as 90 on the certificate of conformity. And if the CO2 of the car is 90, then none of these rules that we've just discussed, salary sacrifice, the reduced company car tax rates, none of those apply to that car. So that's obviously a disaster. The Chancellor said she would do something about it. They consulted on how they would ease the impact of this change in the way that CO2 is calculated. And they came up with something which for them actually is extremely pragmatic. What they basically have said in a nutshell is if the car in question is tested under the new rules, so this is called Euro 6 small e-BIS, if it's tested because they couldn't come up with a catchier name, couldn't have called it Donald or Bernard, Euro 6e-BIS, if it's tested under Euro 6e-BIS and it is a PHEV, then its CO2 is 1, and that's it. You just report 1. And that will be the case on all cars registered up until April 2028 that meet those criteria. And if you're registered up to April 2028 and you meet that criteria, those rules will continue to apply to that car until April 2031. So they've pushed this into the long grass. What it effectively means is if you have a PHEV and it's registered under these new rules, then it still gets the beneficial company car tax and salary sacrifice treatment. What's strange is that doesn't apply for corporation tax purposes. So that car is treated as not being a PHEV, for instance, for the purposes of expensive leasing disallowance and capital allowances. So we have this weird world in which a car will be a PHEV for one set of rules, but not a PHEV for another set of tax rules, which is odd because we had the same thing 2 years ago with double cab pickup trucks. So double cab pickup trucks are still pickup trucks for VAT purposes, but they're no longer vans for company car tax purposes. So it is both a van and not a van at the same time. And we have something similar now with PHEVs, where a PHEV has 2 sets of rules, depending on which rules you're looking at. But the good news is that for company car tax purposes, it's 1 gram, and therefore you can salary sacrifice it and get those attractive rates up until April 2028. And to be honest, 18% from April 2028 is not too bad compared to the rate that could have applied had it been taxed as a petrol or a diesel. EV-ED is this new rule that says that from April 2028, the government will charge us 3p a mile to drive our EVs anywhere in the world. So you can go on holiday in France, do 1,000 miles, and you would have to pay 3p a mile for the journey in France, under the rules as proposed. 1.5p if it's a PHEV. And this is an offset against the duties that they're not getting because the car isn't burning petrol or diesel. The problem with it is, and I mean, maybe we'll talk about this at the end, Rick, because I know that the AFP have been talking to government about this, as had the SMMT, as is the BVRLA. They just don't seem to have a plan for doing it. They've announced that they're going to do it. They initially said it would be based upon MOTs. And then I actually watched the interview where the Chancellor was reminded by a journalist that cars under 3 years old don't have to have an MOT. And she genuinely looked like she didn't know that. So they've yet to come up with a way of actually working out what the miles are, unless anyone has new information that I don't have. And that's why I don't think it will happen. That's my personal view. It's just an opinion. But we've seen this already. We saw this with P11D. And we saw this with eco schemes, where they make an announcement and then they stand by it for 2 years, whilst our side of the fence says, well, you just won't be able to do that. That just won't work. And then 6 months before it's due to come in, they push it back into the long grass. So I don't know whether we're going to see the 3p a mile rate. I will start to believe it when the government come out with concrete, clear and practical ways of measuring the mileage on a car, which isn't going to cost this country more money than the 3p per mile is going to make. VED expensive car supplement, this is the change that wasn't. So they said that the supplement would apply. This is the £400+ a year in expensive car supplement that applies on VED. They said that would apply from April 2025 to EVs, costing £40,000. And then they announced, bear in mind this is now November 2025, that it would be coming in at 50,000 and not 40,000. So it would apply only to vehicles costing £50,001 or more. And that was from April 2025. So the rule never happened. They announced it would come in at 40. They changed it to 50 and they changed it retrospectively. So what we now have is an industry which is figuring out how to get money back to customers, where they had adjusted rentals to reflect this charge on a car that costs less than £50,000. So this is the change that wasn't. Still applies if your vehicle costs 50,000 or more. So you can still get caught by this additional charge. But I think 50 is a sensible place for them to put it. 40 was too low. Eco schemes, they were going to close certain car schemes, employee car ownership schemes, but they've pushed that into the long grass. So we're not now going to see that. Certainly not until the end of the decade, maybe not then. This is another one where they kept saying they were going to do it, and then at the last moment, they just dropped it like a hot potato. So it's gone, or it's gone for now. And that's good news for car manufacturers, because that's how car manufacturers do their own cars for their own employees. Nick, Reclaim is an arrangement. So this isn't a budget change, or not a recent change. But this is where you have cash allowances for employees, and you could be paying them 45p a mile, but you don't, you pay them less. We've all known that you can get the tax back on the difference between what you pay and the 45, but it's now clear that you can also get the NIC back. So you can, if you're paying cash allowances to employees, the employer can reclaim their national insurance on the difference between the mileage rate paid and 45p a mile. And you can go back 5 years for the purposes of that claim. There were other changes. You'll be pleased to hear I'm nearly done. There were other changes effective 6 April 2026, but that's just the usual percentage increases. So scale charges were increased by RPI, that sort of thing. The main one from our perspective, the company car tax charge went from 3 to 4% for an EV. It's only 1%, but it's also 33% higher than it was last year. So company car tax is climbing for EVs, and it will continue to climb. And by the time we get to April 2030, it's going to be a much more significant component of the cost to the employee than it currently is. That is everything I plan to say.
Thank you so much. I would summarize that as tax simplified. So thank you, Harvey. That's great. You were spot on half an hour there, so thank you very much. Carolina, are there any, we might have time for say one question, or if not, we can move on. Thank you very much.
They were just comments about, so Paul agree that a 3 ppm will not happen. And David Bushnell said potentially introduce road charging in combination with the CO2 from April 2030. But no questions up to now.
Okay, I can see one hand up there as well. Perhaps we'll take that at the end, if I may. So if we move on to session 2, and that's Matt. So yeah, Matt, over to you, sir. The pros and cons of running a salary sacrifice scheme from your perspective. And maybe just start with a history of why you actually went into the scheme, as a thought.
Yeah, it's interesting because we didn't go into it for any of the reasons Harvey's just gone through, which kind of contradicts everything that's just been said. We approached this from a carbon viewpoint. So as part of our decarbonisation strategy of the business, we were looking at how we drive down our carbon across all our fleet. And one of the areas we wanted to look at was the cars. And people were probably reluctant at the time to step into EV. I mean, we put this scheme in now, 5-6 years ago. So we used it as a carbon opportunity or an opportunity to reduce our carbon across our fleet. That was our main reason. We gave drivers the opportunity to look at EVs and plug-ins, obviously, from a bit more of a safe viewpoint than going out and buying. I think Harvey sort of looked at his numbers there and said you see fleets are still taking most of the EVs from private customers, and 25% is on the sell-sack schemes now. I think it gave people that comfort, that bit of confidence that they weren't going out blind to buy a car, but they were still supported, probably by a fleet team, should I say, with that sort of knowledge and that support, and they weren't sort of throwing all the money out. They were getting it, let's be fair, slightly cheaper than everybody else. So that's the real reason we went into it. We did a bit of a roadshow on it. We gave people demos and samples, and we had cars outside so they could touch and feel and understand it. But yeah, it wasn't really from a driver financial benefit. That wasn't the key message. It was all about carbon for us.
Thank you very much. And on the con side of things, you mentioned to me that there was some initial pieces and then it got better. But
yeah,
what were the cons piece there?
I think the biggest con we had when we put it in was we treated it like we treated the rest of the fleet. And I think the biggest lesson we learned was this is a consumer piece, and we didn't appreciate that probably when we started. We were very much, this is how we worked a fleet, this is how we've worked company cars in the past. We will treat it the same way. And I think the people who were taking the salary sacrifice scheme didn't really want that piece from the fleet team. They wanted it explained. They wanted clarity. They wanted somebody to talk to about it. Pretty much like when you go into a car showroom, you're talking to the guy who's selling you the car. They wanted that level of involvement. They really wanted somebody to put their arm around them, explain the numbers, explain what it all meant, really sort of go to the details. And I think from a fleet viewpoint, you tend to be a bit more generic because you have that assumption that people are already sort of into company cars, you understand what they're talking about. So I think, yeah, our biggest mistake was we didn't treat it as such. We tried to manage it the fleet team. And what we should have done was go, you know what, this is the relationship between the sales sack provider, the driver, and fleet are actually just a light touch support in the middle if something goes wrong. We probably trying to put ourselves firmly in the centre of that. And that was probably the biggest mistake we made. So when we initially did this, it was a slow uptake. Now, look, I'm not pointing the finger purely at the fleet team. I think there was a big piece where we probably went with the wrong provider. I think our provider didn't really have the people in place and the structure in place to manage that very well. And we only realised that when we moved provider and suddenly saw what the art of the possible was. And I think that was the sort of light bulb moment for us in the whole situation where, wow, okay, this provider really understands what they're talking about and wants to engage with the driver. So as a fleet team, we sort of took a step back a little bit then and again, okay, this is how it should be, and this is how it should be managed. And I think if anything, a takeaway from putting a scheme into everybody, I would say that's vital. You've got to let the drivers talk to the providers. You've got to let that retail feel, if you want that retail feel happen, and that's the best way forward.
Thanks, Matt. Yeah, that feels retail piece. This seems to be coming out quite a lot in the conversations we've been having, hasn't it?
Yeah, and I think there's two bits in there, Rick, as well. Somebody just put a comment in. Nick put a comment in about HR getting involved. We've probably now moved to a point where it is an HR scheme. It's a benefits. You know, it sits with our benefits team as opposed to the fleet team now. But I think you've got to. The benefits team don't understand Salsac. It's not like giving somebody private health or anything else that you might give them. It is a bit of a strange scheme. So I do think the fleet needs to own it to start with. Get the structure in place, and this is kind of where we got it wrong to start with. Hands up, we know that. We changed providers, we relaunched ourselves, we relaunched the scheme. Oh, we must have got it right because the numbers are going through the roof now. And we've got that package, we've got everything in place, and now we've handed it on to the benefits team, and fleet take a real light touch with it. But it is, like I say, it's away from us, it's away from everybody really. It is that retail customer experience. It's that side of thing that makes it work.
Thanks, Matt. Look, you can bask in the glory that you made the EV adoption a safe space for your guys and girls. So thank you for that. I just really wanted to ask some specific questions, if I may, around your scheme and your views. Harvey, I'd like your views on these too, if you've anything to add afterwards. So I suppose the first question was around the options around things like early termination, maternity cover, because you see these protections. What did you do in practice?
We put our own in place, and to be fair, probably because we weren't offered any sort of insurance protection policy when we first launched it. So, Bill, I just said there, you go through every scenario. What happens if somebody leaves? What happens if somebody gets finished? What happens if somebody goes on maternity leave? What happens if someone's on long-term sick? How do we cover, I suppose initially from a business viewpoint, how do we cover the business from a bill? And how do we give that level of assurance to the driver that they're not going to be stung with it? So we actually put our own policy in place, and we put a set amount a month on every rental. And I think it was about £5 or £6. It wasn't a lot, but we said we'll put that on every month on every rental. That'll build a pot, and if we need to use that pot, we can utilize that pot for covering any costs that come in associated with those things. And if we don't, we get the pot back, or we can take a percentage of the pot back and keep a balance in there. So for us, it was a bit better than an insurance policy, because, you know, if we didn't use it, we got it back, or we got a majority of it back. So that's what we put in place initially. But like I say, I know there's insurance policies in place now with certain schemes. We weren't offered that at the beginning, so that's why we went the way we did.
Thanks, Matt. Harvey, anything just to add on that point?
So it's back to if you are large enough and you have the opportunity to, say, for instance, reallocate a car rather than terminate it, then you have the opportunity to keep the costs of these things down. If you're an SME, and a lot of our clients are SMEs with these schemes, then you don't, because you can't reallocate a car, and the cost of terminating one take-on is going to wipe you out in terms of the savings you've made on the arrangement, if any. So I tend to find that the smaller businesses will buy the insurance. The insurance is great in that it gives the employer a degree of cover. So the employee leaves, that's the main thing, the main risk that people are concerned about. The employee leaves, you find yourself with an early termination charge of thousands of pounds. You can't hope to recover that from the leaving employee because you've got one payslip left and there's just not enough money in play. So the insurance will pay out in most circumstances and covers some or all of that loss. So that's really, really cool. The flip side is there are cases where it doesn't cover you. There are limitations on the cover, and actually it's quite expensive. And of course, you have to pay it for every single car, every single employee. So what we tend to find with the bigger companies is the bigger companies will self-insure. They have the size, the scale to do that. They can reallocate cars, they can mitigate risk, and that's a nice place to be.
Thanks, Harvey. Matt, how many in your scheme, out of interest, just to give it obviously to Harvey's point?
I'd say we've got about 90 odd live at the minute.
And how many employees is it total? Or
Eligible
I should say?
employees would be about 600.
Yeah. Okay. So it's a good chunk to go at. Next question. Do you feel that there's the risk that the Chancellor will take away the benefit, as she's done, I suppose, in part with pensions? Matt, do you get any view on that, or any thoughts from your guys and girls?
Yeah, I mean, I think everybody thinks they're going to do something, and it's one of them too good to be true at schemes at the minute, isn't it? Everybody's liking it. I'm pretty sure something's going to come down the line that they'll realise that there's cash that they're missing out on that they're going to claim back. How quick they do that, I don't know. I mean, look, it took them however long to do the double cab pickups, but they finally got round to that, and now they're crucifying that market. So I think it's one of them that it's going to be a short-term benefit, I'd have thought, and I think it's going to get squeezed at some point. How it gets squeezed, I don't know, but yeah, I don't think this is something that we're going to still be talking about in 6-7 years' time, in my opinion. I think it'll fizzle out because it'll either be unaffordable or it'll just get screwed down.
Thank you. Harvey, your thoughts on that question?
Partially agree with Matt in that as the scale charge percentage goes up, and of course it is going up, then the thing will become less and less financially attractive. And I think I said when I was presenting that when you get up to about 15%, then there will be people who are put off by this cost of the company car tax. As to whether or not the Chancellor will just close it, who knows? I mean, who knows what they're going to do next? All I would say is that this does align quite tightly with their environmental objectives. They have been openly supportive of EV schemes. They were never supportive of twin cab pickup truck. They always hated those. They just didn't get round to closing the loophole. I don't think they see this as a loophole. I think they see this as engineering a result that they want to achieve. But by the time you get to 2030, the ZEV mandate being where it's at, they may feel that they don't need it anymore. In fact, I'm pretty sure they will feel they don't need it anymore. But by then, they will be pricing the benefit out and killing it that way. So I think we're probably okay for 3 to 4 years, but I don't have a crystal ball, and I don't know. I don't understand how politicians think.
Yeah, I think, like you said, isn't it? It's probably, you're right, actually, Harvey. The benefit in kind will kill it off if they throw in all the other hidden costs that they're trying to do with the road fund license and everything else. It'll all chip away at it, won't it? Rather than them sort of draw the line. So it'll probably die a slow, painful death rather than a sudden, quick death.
It's probably worth adding, I mean, not something we've discussed before, but the complexity on national minimum wage is really starting to hurt sacrifice schemes, particularly for basic rate taxpayers. You know, people are having to set earnings limits around £35,000, maybe even more, to allow for other sacrifices. And you're sort of pricing out people at the bottom end of the market because of the way it interacts with minimum wage rules. So all sorts of things which are just making this harder as time goes on.
Thank you. So Matt, can you use salary sacrifice to replace your job need cars, your job need company cars?
We haven't. I mean, bear in mind, we don't have that many company cars. So over the last probably 10 years, probably 8 years, we've been making a move away from company cars more towards a cash allowance scheme anyway. So whereas in the past we have probably 300 plus company cars, we've now down to about 80, 90 company cars. So not a massive fleet of company cars. The SALSAC is offered to our cash takers as a sort of replacement to the cash allowance, or as a complement to the cash allowance, should I say, but not against job need company cars. It's not something we've looked at, and I think what you tend to get, and Harvey will probably be able to answer this better than me, but I think as you're looking at more your job need cars, you tend to be looking at higher mileage, so you tend to be looking anything 15, 18, 20,000 miles a year. Once you're getting up with the numbers, any SALSAC or lease schemes, it doesn't really stack up as much. So I think your wear and tear, your high mileage, all the bits and pieces. We've kind of gone, you know, look, job need is job need. We take them on a traditional R&M lease, and we offer the sell sack to the employees here, and also to the cash allowance guys.
Thank you. Harvey, your thoughts? Sell sack replacing job need cars? Question mark.
I agree completely with Matt. You can do it. I've had clients that have done it with varying degrees of success. If you want to do it, so HR like it because HR see it as being cash. The sacrifice becomes a function of what the employee is willing to spend. The employer's contribution becomes fixed. If you want to do it, and if HR want to do it, you can do it, but you might come up with a hybrid arrangement. So we've done this where it's salary sacrifice, but on a fixed term mileage with a degree of employer contribution in the background, so that you don't get a situation where, you know, I live around the corner, so I can contract a car on 8,000 miles. Matt lives miles and miles away. He has to contract on 25,000 miles. I'm in a much better car than he is for the same expenditure. That's a fundamental issue because the cost of the vehicle becomes a function of the contract. With a traditional company car scheme, the employer will set those terms and then pool the mileage.
Thank you. Are there any questions within the chat for Matt on this piece? We've got a couple more questions that I could ask, but just conscious, Carolina.
No, it's more about comments, and I saw that Harvey commented as well.
Thank you.
I think just on this, Ray, one of the things I think what we've got to look at on the sales sack, and obviously we talk about the financial, there is a financial benefit to employees. We talk about the benefit to the business. I think what we find is it's good for making employees a little bit more sticky. And by that, you know, people tend to consider it more. You give them a company car, they don't really care if they're going to leave in 3 months' time and walk away from it. It's not their problem. People give this a lot more consideration, I think, when they're taking a sales sack. Even though we've got the insurances in place and we've got that protection in place, we still do sort of get people asking those questions a little bit more about their future. Well, should I take it over 2 years, 3 years, 4 years? Where am I going to be comfortable at? How do they feel their career, their personal structure is? So I do find it makes drivers think a little bit more before they jump in. They don't just go, great, there's a car I can get there for 350 quid, I'll take it. But you know, it does make them consider. And like we say, we've been quite fortunate, and I do think it makes employees a little bit more sticky to the business, and they kind of feel if they're committing to a sales sack for, let's say, 3 years, they're almost committing to the business for 3 years, which I think is quite nice. So I think there is that side from an employer viewpoint. It's good to see that they are given that consideration.
Thank you. Great. Well, look, I think we're pretty much out.
There is one question. Operating a fleeting team with the reduction of a fleet size by 50%, if we moved from car to salary sacrifice car company, would a fleet team still have some form of a responsibility for the ensuring vehicles are maintained and roadworthy?
Yeah, so I think on that question, I think it's irrelevant of where the vehicle's coming from. You know, we still have a duty of care to our drivers. We still have to follow out the same checks and balances, license checks, driver safety checks, all the bits and pieces like that. Do we have a responsibility for ensuring the vehicle is maintaining roadworthiness? The driver has the ultimate responsibility for that, whether it's a company car or a sales sack. It's down to the driver to do his first user checks on anything along those lines. But from a fleet team, yes, we are ultimately responsible for anything like that. And I don't believe moving from one scheme to another mitigates that risk or mitigates that responsibility for a fleet team.
Thank you. Solid answer there, Matt. So that's the end of the AFP webinar. And yeah, once again, a huge thank you to both Harvey and Matt for their insights. And also thank you, the AFP membership, for joining this webinar. Thank you.